Hey everyone. Now, many of us in the investment space would suggest that during times of uncertainty, the best thing to do is just keep investing. Don't freak out and change up your investments of any sort just because the markets have changed. Keep up with your regular investments. Don't try to time the market. Just don't overthink it. But is this really the best advice to follow all the time? And if it is, does it factor in what's happening now in the world? So I'll break down this question in today's video, and hopefully by the end of it, you'll feel a little bit more certain around how you should be responding to market conditions right now. Because let's be honest, it's a bit scary out there. Now, if you're new to the channel, I'd like to ask you to subscribe if you want to hear more about building new wealth for the new world that we're heading into. And if you're not new here, then feel free to leave a comment and ask a question that I might be able to respond to. All right, now first up, let's talk about our risk profile. Much like it's hard to think like a healthy person when you're sick, or a sick person when you're healthy, it's hard to really know how much risk that you should be taking when the market's rising so well, or when we're in a bull market. For example, during the rising market that we observed in the second half of 2020 and pretty much all of 2021, it would have been easy to say that you were a high risk investor, right? Like in a low interest rate environment, and especially one that looked as though it would never end, almost all investments were rising. What could possibly go wrong? Well, what we do know here, historically at least, is that high returns and periods of volatility or changes in the value of our investments seem to go hand in hand. The return is what we're chasing, and as long as it's occurring, who cares about the risk, right? Like, after all, we tell ourselves that we could get out if we saw danger coming anyway. The issue is we assume the risk and the returns are occurring at the same time. They're not simultaneous, though. In reality, often high returns occur before or after adverse events. Take right now, for example, we now have inflation not seen since the early 80s, and interest rates so high that it'll knock the stuffing out of our property values, our share portfolios, crypto, and our managed funds. The risk, or more accurately, the possibility of a negative return on our investments, came in after the period of great returns. Now, what central banks delivered to us in terms of super normal returns following March of 2020, they're now clawing back through a quasi-tax, if you like, in the form of higher interest rates. Many, including myself, speculated higher interest rates would come after artificially low interest rates and quantitative easing like this. But knowing it sometimes isn't enough. There was no immediate side effects at the time from the good returns. So many, inevitably, took higher levels of risk than what they otherwise should have. So what I'm saying is, when it comes to understanding our risk profile, it's often more important to reflect on financial decisions that you made in the past so that you can apply a filter today for the investment decisions you're currently making. If in the past you panicked as the markets corrected, remember that for tomorrow. Our feelings are far more powerful than we think. High returns require us to hang on tight. We never know what form risk takes when we accept our return, but we know that it's often bad enough to force many out of the market. We can't assume that we're not in that group of people. The issue with selling or liquidating your high-risk investments, though, during bad markets is that you're locking in losses, and most likely you'll also end up giving up gains when the market inevitably rebounds, as it often does. So what about today, though? Is the best practice advice of keep calm and carry on still a good rule of thumb to follow in today's world? Does it factor in the risk of persistent inflation or even hyperinflation? Does it factor in nuclear war and the associated worldwide famine that would happen as a result? Does it factor in a split in the global financial system where the US dollar inevitably loses its world reserve status? Now, am I suggesting these things are about to happen? I'm not sure that I am. Am I suggesting that this time it could be different, though? Yes. And I'll go even further to say every time it's different, not just now. But let's zoom out if you like. Let's just look at what we're doing when we invest. When we go to work, we're converting our labor into currency. We then use this currency to transmit value into containers or investments, which preserve our present wealth for future consumption. Now, if all of our wealth that we're building has to go through the conduit of a dollar system that's increasingly showing signs of fragility, how secure is our wealth really? Sure, the market may rebound, but what about the worldwide systemic currency risk no one really talks about? But here's the issue that financial advisors like me have to deal with around this topic, and I hope you appreciate where I'm coming from here. None of us in the financial advice community are incentivized to provide all of the types of guidance and advice that you may need to hear. It's too dangerous for me to say to you, hey, sell up, the system's about to collapse. And historically, with previous corrections, this is the worst advice to give. So, fair enough. I don't want to get in any trouble by the regulators or by anyone simply because I was trying to keep them safe. What about fund managers? What about regulators or even consumers? In different ways, everyone's incentivized to keep you investing, no matter the market conditions. It's the lowest risk advice to give. It's sometimes the most profitable advice to give. And if investors demand positive returns, it's the advice we all have to take. The entire financial system wants you to stay investing. But what if that's not the best answer? We all want to build up some resource that one day we can stick it to the man, hang up the boots, and go to work because we want to, not just because we need to. We have to take risk to get a return. Last time I checked, there's no other option here. Now, if we look at history time and time again, the story is to keep calm and stay investing. That really is the best guidance. But if it really was different this time in a critical way, would there be any incentive for the industry to warn you? Now, I'm not saying there's a conspiracy going on, of course, and I'm not certainly not saying that you should get out of all markets right away. If anything, I suppose I'm just saying, hey, we probably should stop looking at rules of thumb here and start thinking for ourselves. I hope that helps you in your investing journey and wealth building journey. Please don't take action on anything discussed here. It's not financial advice if I don't know your circumstances. So be sure to get your own advice before you take any significant action here. Catch you next time.